Good afternoon, Essentials Room and YouTube Live. Hope you like that. Like I said, going through this a lot of times over the years sort of helps to have me in here to navigate you through this. We've been leaning the correct way for weeks. So let me show you a number of things we're watching. Now, number one, this is something I showed earlier and it's still valid. This is from one of the books that I read when I first started in the business. This is a typical cycle of a bear market. So first you get the enthusiasm, yeah, how many bought on the way down and kept averaging down, and then you get the panic because they give up and they'll never buy again. But that's not the end of it. So right now we're in this, probably the fifth inning. But then you get this, you get the slow death. And then you get an inverse head and shoulders. So just keep that in mind right here, right there. Now what I want to show you is now, and I want to show you 1980 and 19. Whoa, look at the market rally. Holy crap. Wow, we're all saved. So just keep in mind, we're long. So we're long. So give me 1 second. It's always the tough part about being on is you miss this stuff. Good for us. All right, so let's get back to it. So number one, when you get here, you usually get that massive short squeeze like you're getting now and like you got earlier today. I think we're right here. So I'm going to put this here and I'm going to put it side by side. Remember, this isn't about day trading right now. This is about how to trade panic. So I'm not here to, that's what I'm here to do. So number one, what did I tell everybody about the election? So if you didn't know, if you don't follow me on Stock Twitch or you haven't followed me in the Essentials Room or the Central Room, just keep in mind all this stuff. So that's called When to Sell by Justin Mammoth. So just to let you know, it's about 50 years old now, the book. So Justin Mammoth, When to Sell. But the key in here is this. So in here, like I warned you, all the stuff about lack of regulation, tax cuts, very similar to 1980 and Reaganomics. Like I said, probably now we figure 17 times. You rally into the election, you come and test the gap, you then rally into the inauguration, you test that whole gap, and then you have a bear market for 18 months. So if you think that's a one-off, I went over this a lot. Go to 1980. And when you go to 1980, you're going to see the same darn thing. Same darn thing. You rally into the election, you test the low, you rally into the inauguration, and then you go down for 18 months. Exactly like it is now. And then you got some kind of trend line you could take care of. That one wasn't good. I was on the floor then, August 82. The longer, more points of contact and the more horizontal the trend line, the more important. Look at that. That's a horizontal trend line. If that looks familiar, go back to that graphic. Inverse head and shoulders. Right here. There you go. Inverse head and shoulders right there. Go back. Inverse head and shoulders right there. An amazing thing. So charts do repeat themselves. So keep that in mind in here. Charts do repeat themselves. So what's the next thing we're going to watch? Well, like I said, I think we're here. I want to go back and show you again. So you see the panic. Everybody trying to buy on the way down like I've warned you not to do. So take this panic and then take this. And you're going to see you got the ledge, you got the panic. You're probably going to have the sharp rally, and then this is just the beginning. If the charts ring true. Now, I don't really care. I'm not going to go into tariffs and depression. I'm just talking about what the charts are looking like. I think right now you're getting too much fear. So, but markets there, people are saying there's a reason. So, totally understand. So, I just want to show you that. So, where do we go when the markets get nailed on the opening? What do you do about panic trades? What's a panic trade? A panic trade is trying to take advantage of something that's so far out of whack that even if you're wrong, you're going to make money. So, there are a number of different kinds of panic. Now, by the way, if you're wondering what this cycle chart is, number one, I didn't draw it the best, but this has to do with buybacks. So 5 weeks prior to earnings, companies voluntarily don't buy back stock. That does not mean markets have to go down. What it means is bad news is more likely to take the markets down. Buyback blackout. Yep, buyback blackout. And what happened? They started rallying when the preponderance of companies within the S&P can buy back stock. That's this zone. So you can do a cycle. Now, the cycle, I know there are other people that talk about cycles and moon cycles. I'm talking about just, you can take it even right there. You're going to notice almost every one of these is when companies could resume buying back stock. Like I said, that doesn't mean markets go up. What it means in there is, or down, what it means is bad news is more likely to rock markets. As you see, it's worked pretty darn well. Perfect? No. And this one actually skewed wrong. It should be right in here. That's when the preponderance of companies buy back stock. Right in there. Right there between October 15th and November 1st. Right in there. So that, we could even, we could make it better, but it's close enough. The point is the preponderance of S&P companies are in a buyback blackout. A preponderance of them have earnings probably till up to April 22nd. That's when they can start buying back stock. Guess when this starts to bottom out? The middle, late April. That is something to keep cognizant of. So now let's go into what panics are. Number one, where is support in here? Well, I'll show you. So if you're doing, whether it's a panic or not, prior bottoms become support. Simple as that. Number two, if you have watched me now for months or years, let's see who knows what I'm talking about with the overall market. Where did I say the markets were going to go? So like I said, I'm a student of this, and we watch correlated indexes. When the Russell went to its weekly 200 and the transports on the right went under their weekly 200, then the prediction is the S&P on the left is going to approach the 200. So, which is what it did. Everybody, this was my least popular post on StockTwits, my 57,000 followers. Least popular. They're like, there's no way that this is going to the 200. I got more vitriol about that. Well, you see, it's almost there. So the thing is, where is the actual support overnight? The actual support is right in this zone. So your mission is to find something that even if you're dead wrong, you're still going to come out ahead. So I'll show you. So we're going to go and show you a number of different panic trades. So the first one I want to show you is this for today. We know the support. The first way to do support is take where it was overnight. So when you take overnight, the ES was near the moving average. You see this right here. You see those prior tops right here. That's your zone. That's your zone right there. And that's where it went overnight. So it went into this area. So where was it on the opening? Right in this area, that 4,800. Well, to take advantage of panic, heck, you sell the 4,600 puts today. Holy cow, where are they going to go? Yeah, they went to 8. You're talking about it had to go down another 200 points just to lose money. 240 points it had to go down just to start losing money. That's what I mean by the panic trade. Now, the problem is that because of the nature of the market, the actual, if you wanted to sell a put credit spread, they were too tight. The spread between them was too tight. So to sell a 10-point wide was like $1. It was awful. So I didn't do it. I mean, because the nature of the put skew, it wasn't there. It was very aggravating. So I didn't sell puts, but that's an example of a panic trade. Now, the other one to show in here is this. There's your chart. And like I said, every market's different, but usually this type of sell-off is preceded by a big old rally and then just a slow death till you get the slope to change. This was the problem on Friday. I could not understand how everybody was buying on this sharp slope down when every time it was getting overbought. That's when you want to short every rally, which is what we did. You got to respect the slope. And when the slope is too sharp, you have to just respect that you have to short every overbought condition. That's all. You don't have this where it's turning up on a daily chart or an hourly. Not even close. Too sloppy. Doesn't mean you can't have a nice rally, but you just don't have that kind of turn. So in there, you can't just buy calls, maybe sell out of the money puts. But let me show you a panic trade. So a panic, and it wasn't there on the opening, but I'll show you. A panic trade in the old days, and it would be now, but I'll show you why it didn't work. Now, what would happen is that if this opened down 8 points, you want to try to buy calls that even if it goes down more, the calls panicked on the opening. We looked at the 200 calls. See these? The deal is just take them on Friday. Take the 200 calls on Friday. Go into JP Morgan. I'll show you what we're talking about. So we're talking about this. We're talking about Friday, the 200 calls. So 200 calls, well, that's incorrect. That pissed me off when it's not right. They're not 31. They were like 15. Let me see if I can get it. There. They were 16. I want you to see this. 210 and they're 16. The stock was opening at 202. So it's down 8. But if the 200 calls open at like 7, that's like it being down 15 points. It's only down 8. You were hoping that they widen the spread to like bid 7, offer 15, and they hit the bid at 7. That way, that's the panic trade where you're taking advantage of a disparity. The problem was this, and this is why it didn't work. The open interest was tiny. The open interest was only 114. So guess what? There weren't enough people to panic it. So that's the problem. If it was 10,000, sure, you could have gotten a massive panic. It would have been great for everyone. And you could have bought them at such an edge. Hey, that's why a seat was so expensive on the OE, because you get the public selling on the opening, and we had a huge edge. But they didn't open like that. On the other hand, which one of these has the most open interest? Look at those. Yeah, the 222.5s. See that right there? So the stock opened down and these opened 50% lower. Panic. And an easy way to do it, if you want to know if they were out of whack, is just go to time and sales on a particular option. So go to time and sales and just put in, let's say, the 225 calls. I'm not saying it worked, but I just want to show you an example. Usually what happens is the market makers widen the spreads and they want to buy from you. So let's just see where they were on the opening, the 225s. See on how the market's like 15 cents, the bid and ask, 15 approximately. So now go to the opening. That's when they get funky. So we're going to go to the opening if it lets me. I don't know if it goes back all the way. Yeah. They didn't widen them. Look at that. What a pain in the rump. They kept them orderly. I hate when they're orderly. Let's take the 220s. We're trying to take advantage of panic. We're trying to take advantage of people giving up and getting so much of an edge that you're going to make money no matter what. Yeah, look at that. They just didn't widen them enough. That's nothing. We've seen where it's bid 1, offer 10, and they're like 20 traded a buck. This is ridiculous. It just wasn't there, unfortunately. So it wasn't there. So let's take Generac. We're a long Generac. Oh, let's just take April's. So let's take the April. They didn't trade. Look at that. There, the April 115s. They traded at $1.70. Not a lot. But let's just look at time and sales just for laughs. So, but these are the panic trades where you put in something so low that even if the market goes down, you're going to make money. That's all we're doing. So let's just look for laughs at the April 17th, April 15th. And then I'll show you how to do it with stop. All right. So there's the April 15th. Where did they open? Nah, they were tight. Wow. There's your wide one. But I'm telling you, in the old days, they would have widened them even more. The problem is you didn't have any open interest. You need a lot of open interest so the market makers panic. That's what you're looking for. So let me give you a couple of other things. So there's a whole thing now with EXTO. So extended hours. So extended hours are from 8 p.m. Eastern to 7 a.m. Eastern. Even 8 p.m. on Sunday. The problem with that is you can't short. You can only buy. Yeah, it's a little rigged there. So if I wanted to short GNRC, it's not there. Now, it wasn't that I wanted to do. I wanted to short TLT. But you're not allowed to short EXTO. You can short EXT. You can't short EXTO. But you can buy things that might open so low on a panic. So let's give you an idea. NVIDIA. Oh, NVIDIA going up. Where was it last night? So you go and you put style, settings. $83. There you go. 83 at 2 in the morning. So that's a panic, but you can't buy on the panic. You want to buy after the panic in a constructive chart. even if you're buying at 2 in the morning. Does everybody see the bull flag? After the panic, the bull flag, bull flag. You want to buy on the way up, even with a panic. You got to wait for that turn. So the problem is NVIDIA is incredibly active. So guess what? It's not going to have wide markets. Now, some of these stocks can have wide markets, like Roper, where out of nowhere, the stock could close, let's say, at 600 and they did at 500. You can throw in to buy 10 shares, like down 100 points, but you're not going to be there to monitor it. So there's a number of stocks that can have extremely wide spreads and they panic. You'll see they didn't really panic much, not enough. Now, when does it become a real panic? Like I said, I'm not that bearish here at all. We had too high a put call ratio. We're long. I mean, the only one I regret right now is we don't have Coca-Cola on, which I still might do. But getting back to it in here, what else can you do on panic? Well, there's a couple of things. Number one, the 7%. That's what happens during the day till 3:25 Eastern. Then there are no safeguards. If one of the products is down 7%, that is a huge thing because the indexes stop trading, but the stocks don't. So sometimes if that happens, the stocks will have some ridiculously wide move. This happened in 2015. The ES stopped trading and Home Depot was trading, let's say, for example, 400. And now they had to dump stocks because they couldn't dump futures and it was trading like 300. It's amazing. But we're not there. Everything's a little too stable today. A little too stable. So today is when you look to sell volatility. And I'll show you a panic trade. We did it. We made it. UVXY. And these were posted, by the way, in both rooms. UVXY. So this is designed to go lower. I know there are a lot of people that try to futz around with these inverse ETFs. They're designed to go lower. I can't stress that enough. If you don't want to short this because pre-market it's a little rough, you don't know when it's going to stop going up. So you don't know. But you can play options. So I want to show you an example. So when the markets are getting tanked, the volatility of the volatility goes up. What I mean by that is UVXY, see the expected move is 17 over here. Pre-market, right on the open, it was 28. You can take advantage of that. You don't have to buy puts. You buy spreads. So we did this. We bought the 50 puts, sold the 35 puts, and we bought the 25 puts. We did a butterfly. These are the same place, so forget that. But these right here are 5. These right here are 16. Yeah, the butterfly we did is almost $6. We bought it under 480. So the chart I just showed you is not a thinkorswim chart. That's just a chart from a trading book. That's it. So the thing with the cycles, you just have to put the cycles in. So just put them for every earnings. I shared that last week, just the image. Let me see if I still have it, Helen. No, but I don't have that image. But getting back to it, and I don't have that much time, unfortunately. But getting back to it in here, what you're doing is shorting the vol of the vol. So even if this goes higher, the spread you did is going to make money because the volatility was too high. So right now, the butterfly we did at 380 to 360 is almost $6 because the middle strike died. I want to show you this. Yeah, it's going to be almost $6. So because the middle strike is dying. To give you, for instance, that this, if this slowly goes down, these go to 0 and these are 10. If it stays right here in a week, that's 16. Those are 0. It's a beautiful thing. Well, it's actually 10 and that's 0. Can just take it for this week. It's worth 7. So chart patterns mastery, I sold half. So that's that. And the 2 grid, it won't overlay the cycles. So sorry about that. Just take cycles from the late October and just extrapolate it. So that's what I'm doing. Now, when it comes to everything else, on the right now, we like this kind of thing. So we were showing this. This isn't a panic trade. We're showing all these indexes or stocks are correlated. They all have similar charts. Look at that. All of them have the exact same chart. When you see this, you go on the most expensive. So the most expensive to me is Goldman Sachs, $400 stock. And if that breaks up, then even though these are unrelated, they're more likely to break up. It's amazing on how that works. So we're trying to take advantage of volatility being a joke. To give you for instance, Coca-Cola, 3-point expected move. It's usually $1.50. So how do you play a Coca-Cola? You sell premium. So you probably, if you think it's good, you buy like the 66 and you sell the 70s, something like that. That's what we were doing earlier. I'll probably do it again. So that's what we're doing right now. Like I said, I'm relatively bullish in here temporarily. If it does like other panic episodes, you're going to get a real sharp rally. Whether it's Coca-Cola, yeah, I should have done that. Like I said, there's your triangle. Wait for that triangle. Buy on the break. You're risking 20 cents to probably make $1.50. How about Goldman Sachs? Well, it's a little thin. I'd rather take JP Morgan. So here you go. You buy in here, you're risking $1. That's where to really buy that trend line. But the key is that when you see a trend line break, you wait for that turn on the panic. Now, if I'm right, the SPX is going to have a nice rally, probably into the 5,200 where it was earlier, maybe even 5,400. If it goes on how it's acted in the last 50 years, you get that rally up to here, and then you go down and have that slow death like the chart I shared. So that's the way I look at it. Like I said, ES triangle, and the other thing to watch is the MACD. So right now, the hourly MACD got overbought, but it's retaining its bullish structure while it's working it off. The 15-minute is a triangle, and it's working okay. This is the first time in a week that you've had a tight triangle. Tight triangle. You respect the break. So if it breaks up, which it looks like it's going to do, you buy it with a stop. So that's how I look at it. That's why the tighter the pattern, the tighter the stop. I love tight patterns. So if you're trading the futures, you buy on the break. The more points of contact, the more important. You buy it here at 50, 60, you make your 30 points, you leave for the day. Theoretically, it goes up that amount, another 150, theoretically. So YouTube Live, hope you enjoyed that. Take care, and I will talk